Welcome, everybody, to another week of Wealth Wisdom, where we're helping you build wealth and legacy.
Companies are like an organism trying to survive.
It's always a risk when you're investing in a company that's purely tied to someone's brand.
45% of Americans have gone into debt for a Disney trip.
All right. Welcome to another week of Wealth Wisdom, everybody. I'm your host, Justin Obi. To my left or down below is Eric Benz. And to my right, we got Bill Ryan, both principals at Fox Hill Wealth Management. It's good to see you guys today. It's sun shining, beautiful day. But we have some big news we want to kick off the show today with. We joined Alex Hormozi and School Group, school.com. The Wealth Wisdom Show will be there under Wealth Wisdom Collective. If you're listening, you want to learn more and brush up on your financial skills, join us there. We'll be announcing more as well. But it's designed for everyday people with their financial health and wealth creation, preserving that legacy. So very exciting. We'll link that up in the show notes below. I'm excited about it. You guys are going to be professors now.
Yeah, we'll see.
Yeah. It'll be fun to expand our reach too and be able to help more people. So I think that'll be the fun part of it.
Yeah. And it's a free group, right? So that's the cool part about it is it's free. There's no minimum AUM that you have to join the group. It's a free group that we're going to be doing some really cool education on. But it's, I think, bi-weekly. We're still figuring a lot of it out. So as you join, there's going to be lots of updates happening every week. But right now it's going to be bi-weekly coaching groups, personal financial freedom roadmap coming soon, et cetera, et cetera. So very exciting. And then we also have two other exciting events happening for Fox Hill. If you go to foxhill.com/event list, you can check out, we're doing a Retire Ready in 2035. It sounds like it's far off. It's only 10 years away. Believe it or not, 2035, as it sounds futuristic as it is, 10 years away. So we're helping you with that, a free event to help you prepare for your retirement planning, strategic withdrawals, how to do that in a tax-efficient way. But yeah, all of that, very exciting. And then retirement planning for boomers. I don't know which one of you guys are going to give that presentation with me. I'm going to rope you guys into it. And then let's hit market news. Eric, why don't you take the market news away? A lot happened. It's been 2 weeks since we recorded, so a lot happening.
Yeah, DeepSeek made headlines. The Chinese AI company basically reported that, they created a form of artificial intelligence that was just as good as ChatGPT for 1/20th of the cost and using lesser NVIDIA chips. So what ended up happening was nuclear stocks tanked, Constellation Energy and Vistra were down like 30% on that day. Semiconductors were down big, NVIDIA was down a large amount. I feel like they were like down 15%, something along those lines overall. Yeah. And then data center companies fell. Good examples of that is Vertiv, which does the cooling for data centers, and then Arista Networks, which makes the switches. Those are both down like 20%. And the idea was that if they can create models with lesser AI, then you won't need to build out these massive data centers at the same rate because these models use less energy. They're built with lesser chips, But so comments made by Meta, which is Facebook, their chief AI scientist said that much of the AI infrastructure investments are going into inference, not training of the AI, and that running large-scale AI assistance services will continue to require a lot of compute. So what he's talking about is, we're not building out these data centers to train artificial intelligence. We're building it out for the end user. And we saw that happen on the day that DeepSeek announced that news. People couldn't get on to use their artificial intelligence at all. And that's because they don't have the build out in order to support that large volume of new users. The American companies will have that. And that's why they have to make these giant investments. So we've seen since that news came out, a lot of those same stocks we mentioned have actually rallied quite a bit. They're not back to their highs, but they rallied from the bottom there.
Yeah, it was definitely a buy the dip moment. A lot of people were fearful there. And I think it's a new industry. There's going to be a lot of that happening, a lot of development. Bill, on that day, I was with you here in the office that day. You were calm as a cucumber.
He knew.
Yeah, it just, to me, it just didn't pass a sniff test, right? A lot of stuff that was going on about it. Don't get me wrong, but people can be wrong, and yeah, smart people can be wrong. But when you have that collection of people who are all doing the same thing and spending that type of money and that type of capex, only for someone to come in and say, "Hey, yeah, we can do the whole thing for 1,000th of the price," you know what I mean, or something like that. It just, to me, that just, bells were going off, and I'm like, something is just not right here. I just don't buy in entirely to the story. Don't get me wrong, maybe there's some things that they were doing that are a breakthrough in some sense, but to do it at that low of a price, to do it with that low of the chips and technology and hardware and everything like that they claim to, it just seemed impossible to me. And now there's even more information coming out that maybe they were borrowing, right, some of the AI from other companies. They were using some of that information a little differently. There's been some people say they were stealing, right? You know what I mean? Essentially.
Yeah, the guys from Palantir went out and said that they just stole it. They weren't even trying to imply it. They said it was just stolen.
Matched verbatim, right, to some of what some of the other AI companies have done. And also, too, the people from Palantir said they would not recommend using it because they get from a security. And in other instances, they were like, do you really want this company who is willing to lie about some of these things right now? And they've basically proven, right, that it looks like, again, some of the stuff was essentially stolen. Really want to entrust your information with them. Would not recommend it. You know what I mean? At this time, all those things going, that's what I was thinking immediately, was like crossing through my head. This was even before even a lot of this information come out, but I had a lot of those feelings coming out just because I was like, something just, it just doesn't pass. I felt like this was going to be a short-term thing and there'd be a bounce back in a lot of them. Now, again, as Eric said, stuff has not bounced back quite as much as where it once was, but I do think there'll be recovery and we're going to keep marching forward in a lot of those areas.
Yeah. And I think David Sachs, the new AI czar of the United States, has come out and talked about more data coming through. So it's definitely a story to unfold and to watch. Last week, the Fed kept the rates the same. It was a nothing burger. We all knew that was going to happen. Today, Friday, is recording, I think at 6 minutes ago. We'll see what happens with the jobs report coming out today. Well, I think that's another big macroeconomic kind of measurement we're looking at. Things, the only way, if that comes out really bad, there's some reason for the Fed to maybe consider lowering rates, but otherwise markets are not expecting that.
Seems like the jobs report is going to be a good report. So again, that's just speculation. Again, I think we got to go back. Hopefully we can get our budget, right, like under control. Hopefully these things that they're doing, I think that's going to be the biggest thing. That's actually going to help lower rates here and there, especially mortgage rates, I think, whereas that's what I feel like that's holding up a lot of things for really the economy to really bust loose. If that comes down, I think it's going to come down due to that getting our deficit under control, right? If that does, that's going to be what's going to pull down the 10-year treasury, and then mortgage rates are going to follow. And that's where we'll see, I think, a lot of good things will come from that. So hopefully the things that they're doing, I know there's a lot of controversy involved and a lot of people are not happy. You know what I mean? In some ways, some people are very happy. That's for whoever to fight about, right? But if we do get the budget under control and we are able to get costs down, hopefully those good things will happen. And I think that will be good for everyone. I think that's what everyone can agree on, is that once those rates come down and we get our budget under control and not keep spiraling, I think the one thing we can all agree on is that we were not on a good path regardless. You know what I mean? So we get that stuff under control, I think some good things will happen. So
yeah, it's definitely unsustainable. There's a lot. I think you're right. If we can get the 10-year down, that's going to be huge. The overall, you also have tariffs over the weekend. It was a big hoopla, and then both countries conceded in a few days. So it's definitely a volatile time, which kind of brings us into the main topic of the show today, is investing for the long term. And our approach is always long U.S. equities. And I think having that, let's just dive into it, right? Like in the short term right now in today's market, it's a little volatile. Eric, what can people do if we're long securities, but we want to stay invested in the stock market today? Because we all know that if you miss the top 10 trading days of the market, your portfolio really gets rocked. What can people do? What are we talking about right now?
Yeah, I mean it's staying invested, like you said, and then for newer investors, it's the same thing applies. A lot of people think, "Oh, are we at a market top right now? All these tech companies have run up greatly." It doesn't matter. You just have to get invested and stay invested. You can't time the top or bottom of a market, which we have some data here about like overall historical returns. Typically, the stock market's done about 10% a year over its 100-year history. And so even accounting for inflation, real rates of return have averaged around 7% annually, turning a $10,000 investment in 1926 into over 51 million by 2024. That just illustrates the power of compound interest, staying invested, not timing the market. Like you said, if you're trying to buy and sell as the market swings, which it swings all the time,
Right.
you're going to lose out on those big gaining days.
Yeah. But Bill, if I think the biggest risk of a volatile market is that emotion of, oh shit, I need the short-term cash, right? And you have to sell. You have to sell your stocks, right? And that's like the worst scenario for anybody. It is selling in downtime. How much do people should people have in emergency cash, or should people have liquid assets? How many years of their budget should be covered?
Oh, certainly. Everything comes back to planning, right? With investing, because it's time in the market, right? It's time in the market, taking advantage again.
Yeah.
Minimizing, right? When you're trying to time when you're going in and out, right? So you want to take that out of the equation completely. And you do that by the proper planning, making sure that you have adequate cash reserves so you're not having a dip, dip into your stock. It's going to be different for everyone based on, their job, based on their lifestyle, but all of those things. General rule of thumb though, right? We want to have a minimum of 3 months. So if you looked at like your total life, right? And said, mortgage payments, car payments, utility bills, all that stuff, and just general life stuff, right? Food, all that, 3 months, right? At a minimum. The more conservative you get, you want to ramp that up a little bit more, right? So if you're someone who's more conservative, maybe a little more worrisome, maybe when the stock market starts going a little bit, right? The heart starts ticking up a little bit. You want to push that out 6 months, 9 months. Something like that, kept in cash or an equivalent, something that you can get into within maybe 3 to 5 days, right? Something like that.
Like a high yield savings account or something?
Yeah, totally, right?
Or a treasury bond ladder. Yep.
Yeah. And then something that you want, if you have certain goals, right? You wanted to buy a house by the spring or something, right? That money should be kept in the market, right? I mean, should not be kept in the market. That money should be, again, in those cash and cash equivalents. Money for more, than that, 2+ years out, 3+ years out, 5+, right? That's where you want to have invested in the market, take advantage of, everything that can go, all the advantages that come with investing in the market. At the same time, you're limiting your timing risk, right? Or any of those short-term movements, something like we just saw. You want to be able to withstand that, say, okay, I'm panicking a little bit, but I need to stay invested, trust the process, take advantage of the mess being cleared, and hopefully then getting you back up to where you were and making money again, right? And sometimes that can take, we have a 20% downturn every 3 or 4 years, pretty much guaranteed, right? It's not a question of if, it's just when. It's going to happen by putting these other things in place. These kind of safeguards, that's going to allow you to say, okay, I'm not worried, right? Like during this time, this was going to happen. I'm prepared for this by doing these other steps. And I can allow my investment, again, to recoup, to get back to par again, and then making money again over the long term. And that's so important to make sure you have those guardrails in place so that you can really benefit from everything that comes with investing in the capital markets.
The other thing I noticed that just that one day, right? So this is 1 day sample size here, but a lot of the individual stocks in AI were down up to upwards of 30% or maybe more that day. and just made me think of the power of diversification in your portfolio as well. I think we weren't our overall portfolio. Eric, was that like, we're very diversified but focused. Do you want to jump in there? I think
Yeah.
super important.
I mean, we hit a handful of sectors in our portfolios. So I'll just rattle off all the sectors we're in: industrials, consumer discretionary, healthcare, financials. And then we have tons of multi-sector companies like an Amazon, Eaton Corporation, or Berkshire Hathaway. So we have these giant companies that are also just very diversified on their own. And then we'll also hedge with being overweight with some clients in a utilities portfolio. Those tend to be some of the least volatile stocks. Utilities, that's the last bill you stop paying in an economic crisis. So those tend to be the safer stocks over the long term. But we're protecting our clients' retirement funds by hitting all those different sectors. I will say, though, the past few years, we've been overweight technology stocks, and it's really benefited and helped people build a legacy portfolio that they can pass on to their kids. But we're constantly monitoring, and we want to be in the sectors that we think are going to perform the best. If we think that there's going to be volatility ahead, we'll probably reduce our overall exposure to technology stocks. But we're not going to panic either, and we're going to listen over the long term to what the analysts are telling us. We're not geniuses. We're not genius market timers. We're going to listen to what the analysts are saying.
Yeah. And I think utilizing too, Eric, man, what Vistra has done very well for us. And a lot of times we're going to be, if client needs money or things like that, even it's been performing very well, but hey, let's take a little bit off that and then maybe even spread it around among some of the other utility companies or something like that. So
that's exactly what we did, because it was up 300%, which made it much larger in the portfolio, trimmed it. Yeah, so we trimmed it and put it in some of the smaller holdings to reduce the risk there, because eventually if it gets too large, the whole portfolio is just moving with that one holding's performance. We don't want that to happen.
Yeah.
Right. And those listening at home, it's important to rebalance your portfolios as things like that happen, or be working with a professional to know to do that. Make sure you're still well diversified throughout your portfolio as things change and shift and your life situation is changing, right? I think diversification is so important in someone's portfolio. I just wanted to make sure. We were all talking to a client the other day, and they were closer to retirement. And that was the other thing, is like knowing your situation, like your time horizon towards when we really need that money is so important to know. Bill, what are your thoughts there? We were talking to Paul the other day, as someone closer to retirement versus, like, we were talking the other day, like, I'm full risk on right now, but I'm only 40.
Oh yeah, just going over his situation and stuff like that. And you were saying how I would do. Yeah. I mean, you got to remember, everybody's wired differently, right? Everybody's wired differently, right? And that's just saying at your stage in your life, right? You're thinking, where can I leverage? I want to maximize my rate of return on everything I own, right? You know what I mean? Whether it's my house, how can I be using the equity in my home to then further help me out? You know what I mean? Other areas and things like that. And that's great maybe for you, but some other people are more thinking like, listen, my cowboy days are over, right? I'm settling on the ranch and chill. And so, yeah, that's one thing, like when listening to a client, right? Like you really need to get an understanding of what their psychology and what they're thinking, because certain people think of things very differently. I definitely had clients who, exactly what you did years ago, he was like, hey, I got a lot of equity in my home. I want to take out a home equity line of credit and I want to invest the money, because I think on the spread, right, of that interest, I'll be able to make money over time. This was several years ago. He's like, my plan is I'll just pay it off through my wages, over the next 10 years or so, right? And hopefully in turn, I'll have made this much more money in the market. And this is proven to be done very well, right, for that client, right? But someone who's maybe in retirement, closer to retirement, they're probably thinking, there's no way I'm going. You know what I mean? Take that on. They might say, hey, I'm comfortable, right, with the income flows that I can receive off my assets and maybe my pension, my Social Security, et cetera. Maybe that's coming in. I'm comfortable with that. I want to keep my costs, right, to a minimum. And, I'm happy that my house is paid off. Another payment I don't have going out each month. You know what I mean? Something like that. So,
Yep.
that's why it's so important to have those conversations with your planner, with your investment advisor, to make sure that, again, time horizon, cash flow, all those things are being touched upon with how you invest. And it's important to have those conversations. You want to be talking to your investment advisor once a year, going over those things, making sure that you're not taking undue risks that, everyone's comfortable with. That's the thing, is no two clients are the same. Everyone has different ideas and different things on how they live their life. And I don't want to be telling you how to live your life. I want to work in the confines of your life. I want you to be as comfortable as possible, but I want to make sure that within those confines, I'm doing everything I can to make you as much money, create your legacy, make sure that you're in a great shape, not just now, but in 10 years from now, and 15 years from now, 20 years from now, because there's a lot of things that, hey, you want to be comfortable, but are you thinking about those long-term risks? So I'll be sure that I'm maximizing those things, or minimizing those risks for you and your family in the long term, as well as making sure in the short to intermediate that everything is taken care of and you have no worries. So that's what I'm trying to do with every client that I speak with.
Yeah. And I think there's so much there. Every client is unique and has their own situation. It's so crucial. Guys, great. There's a lot we covered today. I think overall takeaways for me listening, and please, Eric, add here if I missed anything, but make sure you have some cash reserves to cover your short-term needs in case there's a downturn, so you don't have to sell. Diversification, and then just knowing like the long-term market resiliency, and it's continuing to go up all the time. What do we miss here for everyone listening in?
No, that's perfect. Every situation's different, so you got to talk to your advisor, but that's perfect.
Yeah. For next week, we'll be recording again next week, coming at you every Friday right now for this year. If you have questions, we want to hear them. So shoot us an email at hello@foxhillwealth.com. We can answer your questions, your personal questions live on the show, or we can keep them anonymous for sure. So hello@foxhill.com. Come say hi.
All right. Have a great week.
Take care.
See you guys.